Welcome to Product AMA, your daily online Ask Me Anything. We started Product AMA to give those passionate or curious about product management a daily break, something to look forward to. The format is 1 hour in length, weekdays at 3 p.m. Eastern. The first 30 minutes will always be a guest and a featured topic. The last 30 minutes is devoted to you, the audience, to ask your questions. So for today, we're going to take a look at venture capital. We have Alex Baker here, partner at Relay Ventures, to help us with that topic. So for some background first on Relay. Relay is an early stage VC firm that invests in passionate entrepreneurs who are disrupting or creating new markets through mobile tech. Relay has offices in Toronto, which is where our speaker Alex and I are today, as well as Menlo Park, but they're active throughout North America with investments and looking at various companies. So Alex, thanks for being with us today.
Thank you so much for having me.
All right, great. We're gonna get right into it. We always like to maximize our time here on Product AMA. So Alex, I'm absolutely sure, because I know you so well, on an annual basis, I would expect you're speaking to hundreds of companies, whether that's companies that you're actively invested in or highly considering investing in, or just people that you meet, because I know you're very active in the community in general. So when you meet a company at the earliest stage of the conversation, well before you've even considered making an investment, or even have considered maybe taking an in-person meeting, can you talk to us a little bit about the product aspect of that company and what you're thinking to yourself about it, and how the product itself plays out in your decision, whether you actually want to have a more structured conversation with a company?
So generally speaking, we are investing at one of the earliest stages of commercialization. We don't we won't necessarily do an angel deal, but we will do a seed deal, which I would define as early stages of revenue. I would define as early stages of users using the product. A team of a little bit more than call it 7 to 10 people. That would be our entry point. Rarely would we do a deal where there's only 2 or 3 people. So at that point, product plays an extraordinary, one of the most important roles. Second to, I would just say, the quality of the entrepreneur that we're backing. So we are entrepreneur-friendly firm. We're entrepreneur-first firm. We back the jockey before the horse. But that being said, since we are investing on the backbones of early commercialization, product is the key pillar to that commercialization. So we'll spend a ton of time looking at the product, probably as much time looking at the product as we do spend evaluating management.
Wow, so that's a lot of time. I wasn't, when I was thinking about that question, I wasn't expecting that product was that important. Absolutely understand that the entrepreneur that you're speaking with is super important. So why don't we take this a little further then? When you look at the funding journey that you go through, and if you can kind of standardize it, although I'm sure it's not very standardize that journey and highlight where in the process you'll take that closer look at the product and the team supporting it. And if you can highlight anywhere along the way, if your team or any advisors you have would even take a look under the hood.
Okay, so we almost always use our advisor network to take a look under the hood, depending on the sector that we're selling into, or the company selling into. So if it's a financial services product, we'll engage with financial services experts. If it is a property technology product, we'll engage with real estate developers and property developers and property managers to give us some insight. Oftentimes could be with their CTOs, could be other users within the organization, but we'll run, let's call it small user group sessions and get feedback. In those user group sessions that we will run with them as part of the diligence process, we'll begin to uncover the competitive differentiators of the product, other products that these would-be users have seen or have used, and provide that analysis back to the company. But more importantly, as part of the diligence process of what we do and how we do it, and we've done this probably the last 3 years, we've started to really hone in on this specialty. We try to take a holistic view of the product and then break it up amongst the value chain. And then as we're looking at that value chain, we try to understand the dependencies that each handoff has on each other inside of the product, number one. Number two, who the suppliers of either the data or the technology are, because it could be built in-house, but it could also be a third party that you're using for a specific service. And then the third piece of that is identifying gaps. I can tell you that we've spent half-day sessions with companies and product reviewing this. The output is you think of it as a large swim lanes in a Gantt chart where we've got specific a specific level of diligence. We share that back with the company, regardless of whether or not we do the deal. That would not happen obviously on a first meeting. That could happen on a third or fourth or fifth meeting with the company, but it is something that we do regularly now because there's just, first of all, we've got 60 portfolio companies. And so we see a lot of consistent use of different tools inside of acquisition elements of products and what is best used for conversion or marketing automation or things of that nature. We learn something by understanding the new tools that are out there, but we also can provide some insight as to what others are doing when we do the analysis. That's part of the journey. And then there's obviously a plethora of other activities that we undertake, not the least of which is spending, an inordinate amount of time with the CEO and with the executive team, because that's who we have to build relationships with.
Right. No, I see that as obviously very critical, given where you at Relay Ventures invest in a company. Thinking back to my earlier question around the front line, that first encounter, and that you're dealing with companies got an idea, maybe they have some seed funding, maybe they're in market, maybe they have customers, but still you would consider them in the sweet spot of a company that Relay would like to invest in. Just in that moment, how much is of the role of analyst are you actually playing? So because your time is fixed, as all of our time is, and you only really want to enter the companies into that funding journey that you feel are a good fit for your portfolio and are obviously a good bet for your investors.
So I don't know if I have an exact answer for your question, but I can tell you typical situation would be this. Someone in the shop or myself would uncover an opportunity through a variety of different channels. It could be a CEO calling me up saying he's got a friend or she's got a friend that's developing this product. Would I mind meeting with them? 100% of the time I'll take that call. Generally our best leads come from our network like that. The second thing that might happen is CEO might pick up the phone and call and say, you know what, I'm trying to build something new. Would you mind spending some time with us? That could be another source. There could be multiple other sources. Could be things like different industry events that we might attend, we might sponsor. Could be hackathons that we might attend or might sponsor. That's how we'll start to meet people and start to lay the foundation. Generally, the role of an analyst and looking deeply, look, we've got to know the businesses inside and out. We're going to sit on boards post our investment, and to factor that work out to a third party or even to our analyst pool just wouldn't be valuable for the company long term. So we immerse ourselves in the deals that we are getting done, and generally that'll mean committing could mean committing kind of, let's say, post the second meeting with the entrepreneur. It could mean committing 3-4 days a week, half to 3/4 of a day, 3-4 days a week to getting the deal done. And it generally is that much work. Really understanding the competitive landscape, really understanding what differentiates the product. The truth is, sometimes we look at products and our first instinct is to say, this product doesn't look very good. I don't like the colors. They don't agree with, kind of where my headspace is. I don't like the layout of the product. I think that this button should be moved from here to here. And I've had those conversations with CEOs before. And the reality is we can't make product decisions because we're not the ones speaking to the customer. So that's when you have to look at the trends of how people are engaging with the product and take yourself out of the situation and become that analyst and understand how the users engage with the product versus how you or I would engage with the product, and not self-select based on a bias that we have.
So thank you for that. And focusing for a moment on the users, and I just want to make sure that the audience has it straight as they think about their questions for you today. Um, you mentioned users a few times there in your explanation, and I just wanted to make sure that we understood, does Relay invest in companies that are kind of pre-beta, pre-users, or is it generally looking for companies that have a user base, hopefully a revenue stream, so you have that pipeline of feedback and data?
The latter, we will do small deals in the former because we've got an existing relationship with someone. So we'll do that deal. But generally speaking, we try to invest in opportunities where there you can sink your teeth into some data and you have some signals from the market.
Okay. Listen, for everyone who's joined us in progress, we're speaking with Alex Baker, a partner at Relay Ventures. If you have any questions for Alex, we still have a few questions we'd like to ask him before we open up the floor. If you have any questions for Alex, please ask them directly in the chat here in Zoom. So Alex, one of the questions I didn't exactly plan for, but I think it's just helpful to round out, again, their understanding of Relay with the people that are joining us live today. And that's really about the portfolio of companies that you have. And we're not going to get into all 60 of them. I do have a little bit of knowledge here, and I know that you have pillars within your business. So maybe you could just take us through those. I think they're just a handful of pillars. And if you can highlight an example or two of a portfolio company that we may be aware of.
Sure. So, well, we can start with financial services. Fintech's gotten a lot of focus in the market in the last actually 10 years. It's an interesting time on fintech because the concept of fintech really emerged after the global financial crisis in 2008. That's a side story. And so if you think about local companies in the financial services space, Touch Bistro is a local company in the financial services space. They process payments on behalf of tens of thousands of restaurants today. Another company in the financial services space is a company called Payphone, which is based in the US. Payphone is an authentication engine. It actually sits behind every app in an SDK. And they enable every major bank to look at your to look into your phone and ensure that you are who you say you are. So it's the third level of authentication. And then we have a company in Atlanta called Greenlight. Greenlight's a debit card for families. Those guys are, believe it or not, that company is counter to everything else that's going on in the market right now. These guys are growing like wildfire. I guess people are spending a lot of time at home looking at products, spending some time on their discovery engines like YouTube and Facebook, and uncovering the value proposition, which is quite unbelievable. So you can easily transfer money to your kids with a debit card. So that's the financial services side. We have a focus on property technology. Property technology investments are done coincident with Dream, the property management company based out of Toronto. They have an international footprint, and so we've done about 11 or 12 deals in that sector in the last 8 months because we think that prop tech is really it's heating up, and there is a lot of market to be had there. It's still early innings there. There's a local company called Lane as an example that we've made an investment in that manages the landlord experience on behalf of tenants and provides a framework for tenants or an application for tenants to interact with the services that their buildings provide. That's one of, we have Branch Furniture as an example, which is an e-commerce vendor that allows you to buy easily assembled white glove service for desks, chairs, and other office furniture. There's, like I said, 8 to 10. I think I said 10 to 12. It's in that range of deals in that space. Mobility is another focus of ours. We have several companies in the mobility space. We've been invested in a company based out of Vancouver for the last 5-6 years called Mogio, which is a connected car deal. We have another company you all may be familiar with called Bird. Bird is based in LA, but we are opening up Bird Canada. you'll start to see scooters on the street, probably not this year, just given the circumstances of what's going on in the world, but we feel bullish on that for the next year. So Toronto, Vancouver, Ottawa, Montreal, major cities. And then the last one is sports and entertainment, which the pillar for that deal is theScore. You all might be familiar with that. I mean, talk about an incredible product experience. theScore has been, it's one of the first digital engagement products that has been out there from a sports perspective, and media products. It's been out there from a sports perspective, and so that's an area we think has a lot of growth potential as well. So it's really around those four core areas.
Okay, thank you. I know actually that keeps you very busy. And you know what else is busy today? The chat is very busy early on. So out of respect for our AMA format, we're going to get into some of the questions sooner than I would have anticipated. And some of these questions might have a little specific terminology that you might understand, but I don't. But I'll do my best to do justice to the questions that came through. So if we talk about design, you mentioned that already in an example about a button. I know it was just one example. You also just mentioned theScore in terms of a user experience. So for one of the questions that we have here from Ali, it's about product design and how much that influences your investment versus other parts of your analysis, which might be revenue or data, for example.
Well, I mean, so product design, if I understand the question correctly, and you can feel free to just follow up on the thread. Product design leads to engagement ultimately, and so the two are so closely related that if we have a product that we're looking at, and we see 30% retention rates month over month, but leading to kind of 100% attrition rate, within 2 months of the product, and deleting the app off of the carousel or off of your device, it's not something that we would be interested in, regardless of what the industry is, regardless of what the application is, because we could just easily benchmark it against other consumer applications or other B2B applications that are in the portfolio, which we often would do. I mean, the attrition piece is key for us, and so we are forever trying to understand what's going on in the minds of users, and we often can't get there. But retention and still DAU over MAUs, MAUs over the total number of downloads. Look, those are still critical ways for us to look at the applications, because it gives us the highest level view of metrics that we're used to help us understand what engagement is and how the product is being perceived and or used by its users.
Okay, thank you for that. And you know that user experience and design is something that I'm very passionate about. And Dennis is asking about your practice, or is extending it into private equity a little bit. He's curious about basically the model that you have for advisors or full-time staff. I know not within Relay, you've already mentioned that, but full-time staff maybe in other VCs or private equity firms, where that product management function or coaching is brought in-house, and to what extent it is.
So, we're a smaller fund, $150 million active fund, $600 million of assets under management. We have a set of advisors who we leverage, but we don't employ. So most of our advisors are doing the work that they do because they get a view into what is happening at the earliest stages of technology. A model that's emerged in the last 5-7 years, started in the US, in California, has been, and Dennis is right. I mean, it's really been around a paid advisory network, where you have, you can call them entrepreneurs in residence, you can call them professionals in residence, call them what they are. They're there to help the portfolio out. And so we've seen that typically it comes from later stage venture investors, kind of the C's, the D's, and the E's, those guys. Georgian Partners, who's a large billion-dollar fund in Canada, we've co-invested with. I know them really well. They've got an impact team, as an example, and on the impact team, it wouldn't surprise me if within all of their data scientists and engineering group, they also have product specialists. So I would think that a lot of funds would have a product advisor role, in an embedded executive inside of their teams if they are a later stage fund, typically looking at later stage deals where the product management function probably needs to be formalized a little bit better than it is when they make the investment. And that's what they would depend on that executive for.
No, thanks for providing some insight into where the industry has headed and continues to evolve. I want to round out the questions that we, in this kind of first half that we've received already, is one more question around product market fit. And you've already referenced a couple data points in the daily active users and the monthly active users and the downloads if it's an app. But if you could talk to us a little bit about, you know, how early on are you looking at metrics like that to validate product market fit in advance of making an investment?
It will be in the first set of questions that we have, for sure. So product engagement will drive the first, product engagement will always drive the first set of questions that we have for the company.
Okay. No, good to clarify exactly how that fits into things. All right, going back to kind of the larger questions to round out our understanding of your role and the role of Relay and how that relates to product. You know, I know that you're either a board member or a board observer. There's a few different titles that you wear company to company, depending on the company in Relay's portfolio. So basically, as you sit in a room, whether you're at the table or maybe you're in the back row of one of these board meetings of a portfolio company, can you tell us a little bit about where the product person has a seat at that table and what sort of information might be coming out of the CEO to share with the board around the product?
I would say great CEOs spend a lot of time talking to their board about product, because that's the place where they're going to get best feedback on whether or not something's working in terms of the metrics and what market practices we're seeing across the portfolio. The issue with benchmarks that has always been a plague of the industry is that you see the best in class of each category and it doesn't weave the whole story together. So we often won't know, what the relationship is between a certain screen and drop off, just because from a benchmark perspective, you can't get to that level of detail. So great CEOs will spend, either an hour each board meeting or dedicate one board meeting every 3 or 4 board meetings to the product. They'll spend some time allowing their product leader to walk the board through the priorities, how they prioritize the features and functions that that are getting produced, and what the feedback's been on the last set of updates that they made to the product. How has it improved retention? How has it improved the acquisition of new customers and conversion in the pipeline? How has it improved the channels? That's been that's been a great practice for CEOs. And look, the other thing that we can provide, and this has happened now in I'd say 3 or 4 of my portfolio companies, is I leave one board meeting where the company says, we've been reading a lot about what's going on at Spotify and how they're changing to a life cycle product focus group and away from features and functions. So well, what exactly does that mean? It means that we've got a group that's dedicated to acquisition, we've got a group that's dedicated to conversion, we've got a group that's dedicated to engagement, and we've got a group that's dedicated to retention. And then you dig a little bit deeper and you say, okay, well, how is that different today? Well, we're not just focused on features, we're focused on integrations, we're focused on features that are driving a specific function, and you've got functional leads in each of those around, like I said before, acquisition, retention, etc. And we can take that practice and we can talk to other companies about it. And so we've been successful in helping companies achieve pivots, we'll call it pivots, in the way their product management group are focused, based on saying, look, I just talked to this company, this is how they're doing it, I'm not the expert on it, get in touch with the CEO over there. And so the CEO or the head of products will connect with one another, and then they'll start making slight tweaks and changes to each other's methodology to come up with what works for the company best. But to answer your first question, and I'd say we spend as much time on product as we do on marketing, as we do on sales, and as we do on finances.
All right, great. So equal footing, and I would hope to think as much as you're staring at a spreadsheet or a chart on financial projections, you're doing demos of product in those board meetings.
Yeah, look, product is the product. Look, money is the fuel that keeps the business running. Let's not mistake that. But product is if money is the fuel that keeps it running, then product's got to be the wood that's in the fire that just keeps burning.
No, of course, with the kind of investments that you're making. I picked up on one of the concepts you were talking about, these we'll call them pods based on life cycle, as the example you were giving a few moments ago. I think it's important for the audience that we characterize the size of a company. I'll let you help us characterize it, whether it's the number of people or the number of revenue or the valuation or the amount they've raised. I mean, there are any number of metrics that we can use to qualify, but if you can help us understand kind of the size of a company that you think would be, it would be appropriate to develop this kind of functional leadership in product management.
Yeah, so that would start at around, so you would have a product leader, obviously, at the earliest stage. That product leader might be the CTO, it might be a VP of engineering, or the person might actually have a head of product title. But that generally speaking, and generally speaking, at the earliest stage, that person would be an engineer and have an engineering background, not a business background. As that role transitions over time and the company gets bigger, let's say around $5 million, you would generally split the technology and the product function out. And after you split that technology and that product function out, generally what will happen is you start to build your teams underneath it, but those teams will be very functionally focused. And by functionally focused, I mean, someone could be front end, someone could be back end, someone could be working on mobile, someone could be working on Android, etc. So that's as that company grows, $8 to $10 million of revenue or beyond, that's when the company, and size is tough. I've got some companies that are less than 100 people doing this, and I've got some companies that are over 500 people doing this. But as companies grow at that revenue threshold of around $10 million, that's when that change starts to happen. And and that product group starts to get bigger and bigger, and acquisition becomes such a focus area of the company that it's important to put a team just squarely focused on that, who have product chops, who understand how to integrate that product, awareness for that product into different ad units, how to bring new data sets in. Then the conversion piece, again, it becomes a specialty. So I would say it happens more kind of at the $7 to $10 million run rate, but then it just goes boom. It's like a mushroom effect after that.
It's good to characterize exactly how this works, because when we're in talks like this, and I'm sure you speak to people all the time about these kinds of concepts, I think it's important, kind of for the record, to say, while it might work for everyone, it doesn't necessarily work for every company at every stage. It's something you have to mature into, and I think it's obvious.
It doesn't necessarily. It depends on the leadership. It depends on leadership also, and the risk that they're willing to take. So there's a variety of factors, and what they're good at and what they're used to and how they can engage their employees as well. So absolutely, it depends on a whole multitude of things. Revenue is just one of the drivers.
All right. Well, you said something that actually got my heart rate to increase earlier, and it would include both you and I, so I don't feel too anxious about it. But you said that a business person is not going to be in charge of product. So that's okay. I know we're not to apply going forward, but if we can delve a little into the role of Relay and how it supports its portfolio companies with helping them attract product talent, tell us a little bit about that, and then just generalize, for the industry. And I'd say whether it's VCs or private equity, tell us about how hands-on investors of your magnitude are expected to be to support your investments with improving their product function.
Okay, so first and foremost, we would put a business person into a product function, but we generally don't see that person at the earliest stages. So when there's 7 to 10 employees, it's generally a technology person or the CEO, who may not be a technologist, that's in charge of product. as the company grows and product starts to be put under the technology function as that company grows and the CEO's role expands, then beyond that, what happens is that's when you start to hire more like a VP level of product. Then at that stage, when you have 20, 25, 30 people at that stage or more, it could be a business person.
All right.
But
As long as you're
that,
saying there's a chance for you and I.
You are still employable, Mark.
Thank you.
You are still employable. The second part of your question, so I would say we get very involved in the hiring process early on for a variety of reasons. One, our network's great in the city. We've had companies that we've exited successfully sitting here that have CEOs or executives that are looking for their next gig. They're no longer investments of ours. They've had a successful exit before. They're looking for the next opportunity. We plug them in there. We've had companies, frankly, that have failed as well, where we've taken the best of the bunch and we've put those executives into work. That could be anything from customer success to product to technology to CFO, et cetera. So, I would say that we've been largely successful at doing that. And then in terms of also at the stage that we're investing, where the board could be 3 people, sometimes you need a second set of eyes and ears to help with the hiring process for nothing more than just having a different perspective. And so we'll get very involved in recruiting as necessary. So extremely important part of the role of an investor, in my opinion. We don't want to impose our people on the companies that we invest in. So we'll never make it a criteria. There are other types of funds that do that. We'll never make it a criteria, but it is absolutely an important piece to what we do.
Yeah, and it sounds like Relay Ventures is very hands-on with their portfolio companies or potential investments, which is great to hear, providing leadership in a number of categories. You mentioned a word earlier. You mentioned the word pivot, and I know you were mentioning that in terms of the product team, but I'd like to blow that out a bit. And this is something that I watched. I did some preparation for our chat today, and you were you did another one of these sit downs that I saw on YouTube, and there's a lot of talk about the word pivot. So I want to spend some time on a business pivoting and look at your experience about how that decision is made. And I'd like to focus on a company that is within your purview, like a company that you're very close to and are providing the hands-on support that you've already talked to us about today. And just talk about how involved the product function is in making that pivot, and how you, being on the board or being a board observer, are watching this all play out, and what role are you playing as well?
So look, there's different kinds of pivots, right? Some pivots happen overnight, and some pivots take 12 months to happen. And the pivots that take 12 months to happen are because there's been different permutations and combinations along the way, tweaks that the product person has made that make that overall product look different. There are pivots that happen overnight because something's just not working. In which point you would expect the product person to have made a bunch of phone calls to existing and prospect customers to play out what their adoption of the new product is going to be. And it's not ever a brand new product. I mean, you've got to be reusing. We're not taking money and saying, let's create a new company here. The pivots are generally based on some level of insight that you have from the market, some type of technology that you've already built that you're repurposing. And so you would expect that the product person is going to spend a hell of a lot of time, again, reaching out. Great product organizations have their head of product and the heads of the different, pods, picking up the phone and talking to customers and getting their feedback. I would expect that does happen on pivots. And then the other way that pivots happen is that you have natural product additions, and those natural product additions become more successful than the original product that was built. That's another way that you pivot. The product people are going to have 100% involvement in that, and it should in fact come from inside of their organization, the ideation around what's next and how to expand. So I think, I think it answers your question, but product people should be involved in every element of a pivot. I think the notion of pivots it's a misunderstood term, because it just doesn't happen like you're on the basketball court and you're using your pivot foot and you're maneuvering towards the hoop. That's not that's what I visualize when I see a pivot. Pivots happen slowly. They don't really happen quickly.
So the pivot could be like a pull-up jump shot instead of rotating on your back foot.
Just not a dunk for me.
Not a dunk, no problem. Alex and I, for context, used to play basketball together. Used to.
Not a left-handed layup either.
All right. Well, thank you for that. And just a reminder to everyone, especially if you joined us in progress, we're speaking to Alex Baker, partner at Relay Ventures. If you have any questions for Alex today, we are a little bit past the halfway mark in our time today. You can ask them directly in the Zoom chat. We do have a couple of questions. Andrew is asking your opinion from a risk perspective on a company like Clearview AI. Is that a company you're familiar with?
I think the Clearview, Andrew, the Clearview you're talking about is a company that uses facial recognition to identify suspects, unlawful suspects on the street. I think it's pretty tough to evaluate what your risk exposure is going to be in companies early on. In some cases, in this case, it would have been pretty straightforward. They would have had a use case where this works. So they were selling to law enforcement agencies, or they were building a product that, had a data warehouse of a bunch of images of unlawful people. And that, there are privacy issues with that. Obviously, we had a facial recognition company that we had invested in 2009. It was based out of the Ukraine. We had the whole concept of the company was that they could do facial recognition on your device, which was extraordinarily difficult to do at the time. There was, the processing power of the handheld devices weren't strong enough to do more than 10 or 15 people at a time. And so we ended up selling that company to Google. We did quite well on the exit. I was on the board of that company. We ran into some privacy concerns with people not wanting, like I could store Mark's image on my phone and I could identify that it's Mark. And every time I took a picture of Mark, it would get posted automatically and auto tagged into my Facebook page. Well, there are privacy issues around that because Mark never really had an opt-in for it. And so, we worked very hard at trying to figure out what the right magical touch was to get people to use the product and for it to grow virally. And it just turned out that Google wanted the technology so bad that we didn't actually have to solve the problem at the time. And we never thought, by the way, privacy just wasn't an issue when we made the investment into that company because facial recognition wasn't really a thing that you could do on a consumer device. In Clearview's case, facial recognition has been a thing and has been a problem. So I think that the investors knew what they were getting into, or they likely knew what they were getting into. And frankly, if I was on the board of the company and we had invested in something different and they had gone down this path and I thought there were ethical issues with it, then as a director, I very likely would have resigned from the board.
Yeah, it's amazing to think the manner in which our images are being stored, whether it's with our permission or without. Privacy and the ability to protect our data is absolutely a concern. Thank you for breaking that down a bit. And if anyone has watched a recent addition to Amazon Prime Video called The Capture, it's really amazing to think of what's possible with our images and how people can manipulate them. Very different than Black Mirror for anyone who's seen that. I believe that was on Netflix, but love the British television. Andrew O actually had another question. And I don't know if you could speak specifically to a portfolio company or a company, maybe it's a company you would have looked at or aware of, but he was curious about consumer social media ventures or social ventures and the kind of metrics that you're looking for to even consider an investment there.
I wish I had a clear-cut answer for that. And I really don't, because it just depends. When we looked at Greenlight, which is that debit card for families, initially we started looking at it from a consumer perspective and trying to understand why consumers weren't engaged with it, users weren't engaged with it daily, but their retention rates were so high. The answer is really obvious when you think about it. Kids are not shopping daily, they're shopping weekly. And if you're 12 to 15 years old, you're not going out every week with your friends without your parents. You might go out once a month. And so people are in it doing other things, like doing chores and giving their kids allowance, but they're not in it actually conducting a transaction every day. So it really depends versus the score, and if you look at the score and the number of times that someone is inside of the score during the Final Four tournament, or the number of times somebody is inside of the score on any given Sunday during football season, the numbers are through the roof. They could be 30 hits an hour into the app from really active users. And then there could be low activity users could be doing it 5 or 7 times during those days. And it's about the type of product and the engagement. And so it's all relative. We have other companies in the B2B space, 7Shifts, which does shift management inside the restaurant industry. Well, I mean, the users are in there at least daily. The users being the servers, they're in there at least daily. They're checking their shifts, they're trading shifts, they're active in there very, very, very regularly. The managers are less regular. So it really depends on the type of application. I remember looking way back at an app that helped people understand globally where public transit, the public transit availability and how to map public transit. This is before Google was doing it well. And we looked at the engagement there. And one of the conclusions that I came to after looking at the engagement, their numbers were through the roof. Well, they actually were a widget that sat inside of the Android phone. And so their sessions on the widget were being counted as user sessions. So their sessions were through the roof. And it wasn't because they didn't know any better or they were trying to trick us. They weren't. It just was a matter of fact on how metrics were reported that day. And so when we got interested in the business, we didn't end up doing the deal. There just was no revenue model associated with it at the time. But when we got interested in the business, we were interested in the business because the usage was through the roof. But then you dig in a little bit deeper and you understand, okay, it's great usage, but it just depends on the scenario that you're dealing with.
No, thank you for that. Andrew, thanks for the question. And Alex, thanks for providing the comparisons of how to look at data. And sometimes we'd like the data to appear a certain way, but when you do uncover it, and I think a lot about the ad tech industry and programmatic buying and just how much of that traffic, is that real? Just for another comparison. So we don't have any more direct questions for Alex from the audience. We do have kind of a closing question for Alex as we look to wrap up our AMA with him for today. And really, this is more of a focus on today or the last couple of months, focusing in specifically on Relay Ventures. Want to ask you, and again, to the degree that you can answer, please do. Like, what's going on with existing investments or deal flow in general? Are you still making first-time investments in companies? Like, are you still talking to new people? Like, tell us a little bit about your day-to-day and how this change in our routines and has really impacted your day-to-day and those at Relay Ventures.
Look, so obviously, you've seen what's going on with unemployment rates and how that is affecting our portfolio. We're confident that the markets are going to come back in the next 3-ish months for companies or for consumers buying the products of our companies. But today, again, you look at our primary modus operandi these days is to focus on the portfolio. That's the most important asset that we have today, is what's in our control. And so we're obviously spending the majority of time on the portfolio. We have a lot of portfolio companies. We sit on the board of every company that we invest in and are engaged in some way, shape, or form with them. That is, first and foremost on our list. As far as new deals go, a lot of the investment decision is based on a relationship that you can build with an entrepreneur over time. My view is that relationship requires you to be in a less sterile environment than a webinar can provide, or that a one-on-one Zoom call can provide. It's getting to know each other. It's getting to know each other's vulnerabilities. It's getting to know each other's specialties. It's getting to know what the person is good at and not good at. Both ways. There has to be a mutual admiration for one another, because it's a long-term, often 11 to 13 year relationship that you're building from a business perspective, and that it doesn't get turned on and off because you're happy or not happy with them. You still have an obligation to do work with each other, even if one person is not happy with the other. And so it is about building that relationship early on, and maintaining it and getting to know the person. And so without being able to do that, we can look at opportunities and we can understand value propositions, and we can give our evaluation of what we think the team is like. But certainly we can have that other dimension of the person-to-person contact with that individual. And based on that, we're not doing a whole lot of new deals right now.
Okay. Well, maybe you can help us a bit, even though you're not doing the deals right now, and for all of those reasons, and absolutely for many of us on the call or may watch this on YouTube, those reasons apply to so many of our jobs and our roles, that interaction, that level of comfort. But as you look at people who you're obviously not doing business with today because of everything you just described, I'm sure that there are people who are reaching out, or friends of friends who are with companies that might need an injection of some sort. We know the government has not done the best job yet with helping earlier stage growth companies survive this pandemic. So do you have any advice that you would like to give to companies who are having trouble surviving right now, the economics of today, and are having difficulty looking out a few months of being able to see a dramatic shift where their business can resume? What would you say to those people today?
So first and foremost, so let me just clarify, we're looking at new deals. I just think the timeline to get them done is going to be extended, right? So we're looking at new deals, but until we can kind of get back to this physical face-to-face interaction piece where we can spend more than a half hour, 45 minutes with the people on the phone, we're likely going to hold. So just to be clear, we're still looking at new deals. We're getting inbounds, obviously, based on the circumstances you just described. We're getting a ton of inbounds right now, and we're trying to process and look at all of the deals. But getting them done might be a bit of a challenge, just given the environment. I think also, the government has started at several new programs. The BDC's launched a matching program, dollar for dollar, up to $3 million for new money going into some select ventures. Not new investors, but existing syndicates that are looking to extend runway for those companies. And that program's been announced and it's getting started. And so I think there are some programs that the government is doing their best to launch. But I think there'll be there's going to be some ironing out that needs to be done. But for the most part, the government's been pretty fast for the most part to react, but not to deploy yet. So we'll see how long that actually takes to come to fruition. In terms of, look, we've been telling our portfolio companies 12 to 18 months of runway, come hell or high water. And the reason for that is because it takes the markets a long time to recover. And if we look back to 2008, 2009, and the amount of time that it took for companies to recover, they were well into 2011 before we saw prices come back to what they were. But there was still money in the system kind of getting back into the system 9 to 12 months later. So if you look back at September 2008 as a demarcation point when the markets fell, Sequoia launched their RIP, RIP Good Times document. So if we look back to that as a demarcation point, we look at what happened in the venture market, we sort of see that seed deals, the value of seed deals dropped like 50%. The valuations did not come back for seed deals till like early 2012. When you look at later stage deals, Series A, Series B deals, they came back a lot sooner. They would have come back sometime in mid 2011. And later stage deals, C, D, E, they came back kind of a year later, late 2010. It's because they had the metrics the reason we're pushing for 12 months is because we think, if you push for 12, you can actually get more. We think that there will be the market will start to come back in September, October, November in terms of people buying. And we think that as venture capitalists, we're going to look at opportunities and say, okay, we understand what happened over COVID. How did you respond to it? How did your team respond to it? It shows a lot about management style and a lot about management structure. And how quickly is the market responding to your product again? And that'll be the those will be the benchmarks that we use to judge those businesses on. But in terms of advice, that's the advice that I would give is exactly what we've given to our portfolio companies. 12 months, 18 months preferable.
Well, thanks, Alex, for that answer. And I think for anyone listening or will be watching, it sounds like being in your portfolio right now is a great place to be. There's clearly leadership, from you. We're hearing it today, and I suspect from those around you at Relay Ventures. So congratulations on that. Just want to thank you so much for taking the time. I know that there was some background action in your house that I was hearing as you were speaking. So your ability to power through that and give us great answers is very much appreciated.
Like everybody else, there's background noise all over the place. Hard to stay focused.
No, you did a good job. So thanks everybody for joining us today. Have a great day and a safe day. And we hope to see some of you tomorrow if you're interested in the product marketing side of things. Thanks so much again, everyone. Be well.
Thank you, everyone.
Follow Product AMA on Twitter and send us your topic suggestions. We look forward to seeing you soon.